Hi everyone, my name's Darryl Panes. I'm here with my brother Brian, as always is the case, and we're at the Sofitel Hotel. We're still here. This is the second main day of the conference, and look, we just came back from listening to a gentleman that I thought had something really special to offer. His name is Louis Boulanger, and is that right, Louis?
That's all right. That's great.
Louis and Brian and myself were all on the same page, and I just thought the information was really fantastic. And so, welcome, Louis. Just appreciate you putting aside the time today. It's really fantastic that you're prepared to do that at short notice, should we say.
Welcome indeed.
Here's what I know. Louis, governments are telling us all around the world that the economy is in great shape.
Aren't they? Yes.
Okay, so heaven knows what it'd be like if they were admitting it was in bad shape. But we're looking at long-term low interest rates. We're in uncharted waters. Even Janet Yellen of late was suggesting to us that this is an experiment. We really don't know what to expect. This was a couple of months after she'd told us that she didn't expect to see another major economic downturn in her lifetime. So here we are, uncharted waters, an experiment. Interest rates at all-time lows, another bout of QE after we've already had three QEs, and now we've got QE that's not QE. And so who knows? Well, I think I have a pretty good idea where we're heading, and I know that you certainly know where we're heading. With all of this around us, what are your expectations moving forward?
Well, they're not good for the system, for the monetary system and the financial system. As far as the economy goes, you know, there'll always be good companies, and there will always be, productive people. You know, some companies might fail. I think there's a lot of speculation, and there's a lot of misallocation of capital as a result of how investments are made today. A lot of money goes into passive funds, and so more money is allocated to the big, like Apple and companies like that. Might not need any more capital, really, and all it does is increases the share price when perhaps there's some smaller startup competitors that would do well with some more capital. Now, in the monetary system it's incredible that it's survived this long. Historically, a global reserve currency lasts 40 to 50 years, and the U.S. dollar has been at the center since 1945. But they didn't have derivatives in the previous eras. They didn't have central bankers doing prestidigitation. Is that how do you pronounce it? Magical tricks with their wand. And here's the real problem, and this is what was my main message at this presentation I just gave, is that central bankers are taking us to a place no one knows. We have no idea. You said I know how it ends. I don't. All I do know is that money's going to have to change because fiat money ends to zero. But it's not just the central bankers. It's those who manage other people's money. It's the financial advisors. It's the fund managers. I mean, I talk to them. I'm in the industry. I'm a CFA charter holder. I'm a professional. I gave a presentation last week in Wellington, and there were fund managers, investment advisors, even people from the central bank that came and listened to me. But they don't act in accordance with what I tell them, obviously. But what I mean by that is that they're not really thinking about protecting their clients from the system. They're not really thinking in terms of systemic risk. They have full faith in the system and the ability of the central bankers to steer us, out of this mess somehow. Well, it's pretty clear at this stage they can't. They tried, and boy, was it not going well earlier this year, right? But here's the thing: we're going to have a recession at some point.
They're basically out of bullets, aren't they?
And whenever a recession started, central banks have had to reduce interest rates by 5%, 4-5%. Yeah. Admittedly, interest rates were higher than they are now, so maybe a 2% reduction would have the same effect. I don't know. But even
2%
2%, you end up at even the U.S. being in negative territory.
Yes.
When just a few months ago, Jerome Powell was telling the world that, this is on autopilot. We're going to increase interest rates for half a point every quarter until we reach 3.5. And so they don't know what they're doing. Now, as you said, they've started another, I call it monetization, because quantitative easing is just a fancy expression. What they're doing is they're monetizing the debt. They're not really printing money, but they're buying the debt, with money that they create. So monetization of the debt never ends well. And so this is monetization number 4. I think I borrowed that from Bill Fleckenstein. Do you know Bill Fleckenstein?
We know Bill Fleckenstein.
Yeah, Bill Fleckenstein, great guy. I subscribe to his daily comments, daily rap. And he said, I'm tired of calling, all the QE, no QE, POMO, permanent open market operation, TOMO, temporary open market. Hey, it's monetization, okay? So, but they're doing both. They're doing that monetization, which is really buying securities, like under QE, but they're also providing now $120 billion a day of liquidity in the overnight repo market. That's unheard of. And they do it every day. They started with 60 billion a day. That wasn't enough. And they said it's going to be over in a week. That was 17th of September.
Yeah.
And I know. So what is going on? Banks won't lend to each other at the low rates. Interest rates want to go higher. For me, that's the message. Banks will not lend to they want to keep the paper that's good quality, and they're not going to provide funding overnight to other banks or corporates, because the repo market is not just banks, it's commercial interests and so forth. And so, and you could argue, as they did in September, it was the end of the quarter and there are tax issues or whatever. It could be that companies were caught, with, oh God, not enough money in the kitty. But hey, wait a minute. It carries on and it goes up, and don't look here. There's nothing to see. We'll find out. And when I started my presentation, as you know, pointing out that a central banker of Holland, the Netherlands, came out. I mean, admitting that gold will play a role when the system collapses.
That's a serious statement, wasn't it?
That is, and I had to read it more than once to make sure the source was authentic and not someone creating this comment, quote. But no, it's they know. The central bankers, those in charge of the monetary system, whether that's the Fed, the BIS, the Bank of International Settlement, has already this year, more than once when they speak in public, made comments to the effect that, we've reached our limit. Central banks, the monetary policy has reached its limit. Now it's going to be fiscal. The governments have to do more. And that's what's going to happen. We're going to see helicopter money. We will, before this is over.
Well, that's all that's really left, isn't it?
That's all that's left, yeah. So
well, the next big thing is MMT, isn't it?
That's what MMT is, really.
Money,
Modern monetary theory is really money that goes straight into the economy or to the people one way or another, or shape. You don't actually issue debt to finance it. You don't pay interest. You just create it and give it. Now, we know how that ends.
Never will.
It will when my colleagues in the industry finally realize that they need to buy gold. When they start allocating more than zero of their clients' investable assets to something like gold, things will change, because it's money coming out of the system. It can't be good for the system, can't be good for the economy either. Sorry, but you forced us into it. Our role is not to save the economy, it's to save our clients, protect our clients' purchasing power. But no, they're far from being at the point where they're going to, I do that. I mean, I started my business when I left a big consulting firm, and I took on some private wealth to advise. And I said, well, look, I'm more than happy to give you investment advice on your portfolio. But here's the thing you have to understand. You can't invest all your money. We have to put some money outside the system, and that's in gold bullion and silver. What?
Never heard
Why
of that
would you
one.
want to do that? Here's hours and hours and hours of explanation as to why. But I said, it's very important that you understand this if you want me as your advisor. Because I won't rest easy investing in the system
Absolutely.
if you don't have something outside the system to protect you from systemic risk. I've been doing this for 10 years. My clients understand what gold is, but they understand it because they willingly accepted to listen and learn.
And learn.
When I speak to the industry, they listen, but they don't really, Alf Field here spoke at one of the conferences Kerry organized years ago, and he said something that was profound, and I have since called it the Moses effect when I try to explain to the industry why you feel that way towards gold. You've been in the desert for 40 plus years. You haven't learned anything about gold. No, I went to university in 1972. That was the year after Nixon defaulted. I took classes in economics. Nobody talked about that.
No, they
Well,
wouldn't.
what the hell are you talking about? You're teaching me how the banking system works and the reserve bank. That's all good. I need to learn that. All right, but hey, wait a minute. What's a dollar worth? And I'm from Quebec, as you know. So we're close to France in many ways, and history not long before 1971 was France sending military ships across the Atlantic Ocean
Exactly.
to get the gold, because they had the right under Bretton Woods to demand gold for their dollars, and they didn't trust anyone with the delivery, so they sent the Navy ships. That's the goal.
That's serious stuff.
Serious stuff. Well, the next country that tried to do that was England, and that's when they go, no, we're not doing this anymore. We've closed the gold window.
Correct, exactly.
Temporarily.
Yeah.
Anyway, so it's history, and I in my explanation of what gold is to newbies, people who don't really know that gold is money, I say to them, look, there was no oil crisis in the 70s. When the price of oil went from whatever it was, $10 to $80, $60 a barrel. That was because the Arabs were pricing their oil in gold.
Yeah.
They were happy to take dollars, but they didn't know what a dollar was worth. And they could see that the price of gold in dollars was going up. That means the dollar is worth less. Yeah. So they're smart. And it seems like a good chunk of the world, you think China, India, Middle East, Russia, many countries, they know. But in the Western world, it's almost taboo to talk about gold.
Oh, no one understands it.
Yeah.
I mean, you brought the point forward in your presentation today that there's been average return from around 2000 until now of 9% or thereabouts per year.
Yeah.
I mean, you've got to be kidding. I mean, that rates very highly with all the other markets, doesn't it?
Yep.
And yet no one knows this.
Exactly. I mean, how can you ignore gold as an asset in your portfolio when it does so well, and it correlates negatively or very low correlation with most other assets like equities or bonds? What's not to like from a pure diversification point of view? But 9% per annum over 20 years, that beats,
fantastic.
beats Warren Buffett.
Yeah.
It does.
Yeah.
Gold beats Warren Buffett's over 20 years. I mean, that should never happen, really. But it does, simply because money, you see, money is purchasing money. Fiat currencies purchasing power is eroding really fast. But we don't see it because all currencies are priced relative to each other. So they're all going down.
Yes.
So it's not like...
Yeah, exactly.
It's right? So we're all in this together.
We're sinking together.
If we had an anchor of some sort, which is what gold is in the past used for in a standard monetary system, we'd know. We would know, because they'd have to reprice the currency in gold terms all the time, to maintain confidence. But no, the dollar is strong, the dollar is strong, the dollar is strong. Yeah, well, it is relative to other currencies,
Yes.
but, relative to gold, it ain't.
No.
I think in that chart I showed, gold performed the best in Indian rupee, and British pound. Third came the US dollar. Was 9.5% per annum the last 19 years. US, Australian dollar, New Zealand dollar, did better than the US dollar over that period of time. So it went up slightly less, gold price. But still, on average, 9%. What's not to like? I mean, buy some gold and go and play golf, Why, get so hung about how to invest, so complicated,
Well, it's not complicated. I have, we have a number of clients, but there are a couple in particular I'm thinking of right now. Going back 3 months ago, purchased, had never been in precious metals before, but they've been talking about it for a while, and spent $1 million and just on silver. So it was 15 kilo bar denominations. And they're obviously very much aware of what sort of return they've experienced on that.
Yeah.
And it's $250,000 on $1 million in the last 3 months.
Yes.
And I would suggest that, I know it's been a beautiful period. Silver's up 25%, thereabouts in that period of time. But the way the economy is functioning at the moment, it would not surprise to see a repeat of that over the next 6-12 months. And so
anything can happen. That's the unfortunate thing, is that it's so unpredictable, because the spot price of silver or gold or so many other things is set in the futures market, not in the physical market. And if the positions weren't so highly concentrated in the big banks, commercials, you can understand the commercials to have huge positions in the futures market. They have to manage their business and the cost of operating. But the banks, what the hell are they doing there? Why do they have such short positions in the metals? So it's affecting the price to the downside. And that's most unfortunate. It should not be allowed, such high concentration.
Well, I was listening to the gentleman from the World Gold Council yesterday. You may have been there, but he was saying on a daily basis the amount of gold dug out of the ground, what is being traded, is 820 times more than what each day the gold comes out of the ground. 820 times.
Yeah, but it's what would be the correct number? I don't so much have a problem with having a lot of trading on the asset, but the price of the asset should be fundamentally based on physical demand more than on paper. How do we get there? Well, maybe China will help us.
Maybe.
Because the Shanghai Gold Exchange is becoming more and more important. They have a better standard there of delivery than the COMEX. COMEX, if you stand for delivery, they give you a piece of paper that say, we've transferred that delivery request to London. I can't remember what they call them exactly, but that's another secret operation that we don't know much about. There's so much secrecy in the gold world or the monetary world that it's amazing that we put up with it. I mean, I don't know why it shouldn't be secret. I mean, it's money. We work for dollars. We invest and save in dollars. We should know what's going on in terms of what is that dollar going to be worth. How do you manage the preservation of purchasing power of that dollar? No, that's not trust us. We know what we're doing. Hey, we're PhDs in economics. That's the worst qualification, because you're so groomed into advanced econometrics and maths, and human action you cannot explain in a formula.
No.
Economics has lost touch with what it started being, Austrian school and what have you. It's just completely lost touch, and it's a cult. It's a boys' club, And I really don't understand why people put up with it. The only explanation I can come up with, which is not a sufficient valid explanation, but it could be the reason, is that everybody in the industry has, invested a lot of their time and to get educated, get the right degree, CFA or whatever, and they got a big job, they make a lot of money, and I was that guy, for a number of years until I left the firm and took a year off and found out about money. read books that were published before 1960 and 1971, like Jacques Rueff, who advised de Gaulle. It was translated in English, The Monetary Sin of the West. He wrote not editorials, but pieces that were printed in the editorial page of Le Monde. He was Greta Thunberg in the monetary world in the 60s.
Right.
But as an official, as an economist, as the number 2 man in the French government, or the number 1 in finance, Jacques Rueff, you read that and you say, I went to university 5 years later in a French university, and nobody even told us about this.
It's like the communists burning the books, isn't it?
It's trust. You have faith. They know what they're doing, and it's been like that so we've been in the desert for 50 years.
The government would never do that to us.
They
couldn't think
They're
of that
nice
idea.
guys. We elected them, right? We'll throw them out of office, elect new ones. Same old
thing.
I guess what it is that how people say, well, how long can this continue? Those, of course, have done their research. It does until it doesn't. That's really the point, isn't it?
That's the point. In my presentation, that's why I talk about complexity theory or systemic risk. The nuclear reactor, as opposed to the thermostat. Tweaking with interest rates. It works for a while, but eventually, because it's a complex system, it's like a nuclear reactor. We'll reach a critical point. We don't know when. And at that point, everything will change. They're getting ready for it, That's why they're buying gold. That's why they're buying gold. They know the system. Even Mark Carney, who's the head of the Financial Stability Board of the G20, gave an amazing speech at the powwow of central bankers at Jackson Hole, that they have every year. I think it was in August. Basically saying, we should dump the US dollar as a reserve currency. We should have a digital currency, global digital currency, and blah, blah, blah,
Yeah.
Okay. So there are signs regularly, every week, something comes out from someone in officialdom that really tells you what the conversation must be like behind closed doors. And hopefully, they're going to do a good job in reforming the system so that there is no collapse, there is no massive crisis and debt, not debt, but loss of wealth. I doubt they'll be able, because they seem to be so gung-ho on thinking too much debt can be solved with more debt. It's the definition of insanity.
Yes, yes, it is. Yeah. Look, I think Jim Sinclair says it pretty correctly, and you've already mentioned that the fact that the central banks are buying in more precious metals than they have for a long time and will continue that. So you would think that the line of thought there is, okay, if it's okay for central banks, then it's why not us? And Jim Sinclair says this all the time. If you want to become or generate wealth, absolutely, become your own central bank makes enormous sense. So I guess parting words, because we don't want you to give away too much of your information, because guess what? We've invited Louis back to Australia next year, which would be fantastic if you could attend our event, Louis.
Sure.
This will be in Adelaide, of course. We haven't run an event for about just under 2 years now, but this will be a really big event. And we don't want you to give all your information away prior to that event. But if you would like to share, just with reference to gold and silver right now, okay, we don't know what the central banking system's going to do. We're not sure what governments are going to do. But to seriously protect your wealth, what would you, it's just your parting comments, closing comments, what would you suggest to our audience today? How should they best protect? What should they do?
Well, it's basically what I tell my clients is that you should have at least 20% of your investable assets in gold.
Yeah.
And then we can go and play in the casino like everyone else, in the financial markets, and not be too worried. If it goes poof or whatever, you'll have something to fall back on. From that point, the conversation can extend as to how to do that in terms of gold and silver, or how to implement that. Where do you buy the gold and what kind of bars? I do it on the London market and the wholesale bars, if the client is significant enough in terms of wealth, of course. And also, when that 20% creeps up over time, what do we do? Do we do what everybody does in the industry, rebalance down to 20%, and do we just let it go up and invest that? That's a conversation and it goes either way depending on the client. I mean, there's no hard, why 20%? I mean, it's the old 80-20 rule. It's not rocket science. I mean, there's no, but the World Gold Council and many others have done good work in terms of correlations and what should be the optimal allocation to gold in a diversified portfolio. And they end up, depending on how much risk, how much equity you have in your portfolio, the percentage goes up. So it ranges between 3% and 8% or something like that. That's all good, but gold should not be in your portfolio. So that you throw that out the window. Gold is not an investment.
No.
Gold's cash. It's like, can you imagine putting dollar bills under your mattress? Maybe not under mattress, but in a vault, secure. It's the same thing, except it's not dollars, it's gold, it's cash. You don't sell gold, you spend gold. And you don't spend gold until it's recognized as money.
Recognized as money.
Yes.
One last question, or certainly from me, and then Darryl can finish off. We grew up in the 50s and 60s, and my father had a good manufacturing business, and it was go, go, go. The business manufacturing was doing well. There was a lot of money around, full employment, and then we have today where there's really a lot of unemployment. Yes, people have got employment, but they've got 3 jobs instead of 1. There's service industries. And then housing is just unaffordable in most people. Are we headed for a recession, a deep recession, or even a depression? What do you think?
Well, definitely a recession at the very least. And the only reason we don't have a recession already is because of the suppressed interest rates.
Yeah,
sure.
And it's the same thing goes for the real estate. People don't really know. They don't look at, when they buy a house, they don't really say, oh, is it worth $1 million?
No,
they don't care. They're like, can I service the debt? And the banks tell them, yeah, you're good for $800,000.
With a 2% deposit. You can afford it.
What do you mean I'm good for that? I earn $70,000 a year. Yeah, you're good. I tell you, we worked it out. What if interest rates go up? That's not even a conversation.
No.
And that's wrong. That is wrong. It is imprudent, and it should be illegal. When you take on so much debt, you should know what the consequences are. In the U.S., at least, there's jingle mail in the U.S. So you can borrow $1 million. If you can't pay it back, there you go. The keys in there.
It's yours on the table.
It's you can't do that here. Only in the U.S. you can. I don't know why you can do that in the U.S., but it's a strange country.
Strange ways with finance where you know that. Yeah.
My son lives in Chicago. He's got an MBA from Chicago University, and now he's a fund manager, basically, or an analyst for a fund manager. And I say to him, don't buy a house in Chicago. Keep renting, because they're going to tax the life out of you. This is a bankrupt city.
Yes.
Yeah.
Yeah. So far he's listening to me, but I don't know for how much longer.
Dear.
Louis, I've got to thank you so much because this was quite impromptu. And I drew you away from the auditorium and you didn't hesitate in coming and supporting us today. So that's absolutely fantastic. So thank you so much. And I know that you're going to get a huge reception when you come to Adelaide next year.
Look forward to that. Never been to
well,
Adelaide
you're not that
before.
far away.
No.
I
don't know why I've never been before. Business hasn't taken me there, and on holidays it was not on the radar. So.
Yeah, well,
but visiting the wine producing area.
Look, if you can stay for an extra day or two, we'll make sure that happens.
Definitely.
I can assure you, we've got some beautiful wineries down there.
Yeah, I know.
So look, thank you so much, Louis, and it's just been we're very thankful. And look to our viewers, we feel as though that you would have benefited from listening to this conversation today. It's been, this gentleman is right on the same page with Brian and myself, and yeah, well, hence the reason we interviewed him. So, hey, thanks very much to our clients. Thank you so much for your constant support. Really appreciate it, and we look forward to seeing you next time. Bye for now.
See you
Louis.
next time.
It's a pleasure.
Appreciate it.